Assalamualaikum warahmatullahi wabarakatuh. My name is Nabilah Natasha, binti Md Nor Sham, and I will be the first presenter for today. We will start with Part A, Segmental Reporting, MFRS 8. So let's begin. Alright, we will have 4 agenda in MFRS 8, which are first, company background, second, management approach, third, reproduce segmental report, and fourth, conclusion. Alright, for the company background, FGV Holdings Berhad, or formerly Felda Global Ventures Holding Berhad, is a Malaysian-based global agribusiness and food company listed on the main market of Bursa Malaysia on 28 June 2012. It is an affiliate of the Federal Land Development Authority, which known as Felda. The initial public offering, which was the world's third largest raise, which are RM 10.4 billion. It was incorporated as a commercial arm of Felda in 2007 to oversee investments in the upstream and downstream palm oil businesses, as well as other agribusinesses. On 3 July 2018, the company dropped the base Felda Global Ventures from their corporate name and renamed as FGV Holdings Berhad. FGV is supported by a strong workforce of more than 45,000 people. FGV are focused primarily on 3 core business sectors, which are first, plantation, sugar, and logistics. Mission of FGV is to be a global leader by first, creating value through human building, second, building an integrated value chain advantage, next, the embodiment of governance and compliance, and lastly, cultivating diversification in commodities and geography. Vision of FGV is to be among the world's leading integrated and sustainable agribusinesses and delivering value to customers and stakeholders. As we can see in the table above, here are the organizational values of FGV. P. Partnership, R. Respect, I. Integrity, D. Dynamism, and E. Enthusiasm.
Next, I will explain about the management approach. Firstly, let's take a look at the factors to consider having a segmental reporting. The first factor is nature of the business products or activities. Under this factor, we have the nature of the products and services, the nature of production processes, the type or class of customers, the method used to distribute the products or to provide the services, and the nature of regulatory environment. FGV Holdings Berhad is a Malaysian-based global agribusiness and food company which focuses primarily on 3 core business sectors, which is plantation, sugar, and logistics. The second factor is existence of managers responsible for the activities. Managers are responsible for the processes of getting activities completed and achieving the firm's goals through the execution of 4 basic management functions, which are planning, organizing, leading, and controlling. FGV has a good management team led by Muhammad Nazrul Mansor, who is the Chief Executive Officer of FGV, and under the management team, we have Azman Ahmad as the Chief Operating Officer. Move forward to the information presented to the Board of Directors. The information provided to the BOD when it does not to be considered the CODM, it may indicate at a level which our overall performance is assessed and decisions are made about the resource allocation to as well as different areas of an entity's business. Okay, next we move to the type of segment. Basically, FGV use 2 segments, which are business segment and geographical segment. Business segment is a unit of entity that is engaged in providing product and services to consumers. For example, FGV have plantation, sugar, logistics, and other segments. Plantation estates activities include cultivation, harvesting, and production of fresh fruit branches and processing it into crude palm oil and palm kernel. Next, sugar segments did the sugar refining, sales, and marketing of refined sugar and molasses. As for logistics, it focused on bulking and transportation facilities and services. Lastly, FGV also have other divisions that provide engineering services, information technology, and travel. Next, for geographical segment, which is component of an entity that is engaged in providing product or service to consumers within a particular economic environment. For example, FGV Holdings Berhad has separated their geography segment based on regions such as India, China, Pakistan, United States, and Canada. Let's get to know who is the Chief of Decision Maker, or shortened as CODM, and its responsibilities in FGV Holdings Berhad. As stated in quarterly report of FGV Holdings Berhad, the group's CODM is defined as Group Management Committee. For plantation segment, we have Encik Muhammad Sarian Muhammad Sahid as the Group Divisional Director for Plantation Sector and Head and Upstream Division. Other than that, we have Encik Muhammad Fauzi Hassan as the Officer in Charge and Chief Human Resources Officer. For the sugar sector, we have Said Faisal Said Muhammad as the Chief Executive Officer or CEO. Lastly, for logistics segment, we have Azman Ahmad as Group Divisional Director. The responsibilities of Group Management Committee (GMC) or CODM are to support the Group Chief Executive Officer (GCEO) in the stewardship of the group, to centrally monitor the group's performance. Furthermore, to coordinate and align the group's management and business operations to achieve FGV Group's vision, mission, strategies, good corporate governance, principles, and best business and control practices based on the directions, guidance, decisions, and policies of the board and the board committees. General functions of CODM are to assess the performance of the various segments and to decide on allocation of resources to the segments.
Next, we will discuss the process to identify the reportable segment and non-reportable segment by using quantitative threshold test. It is by using 10% threshold test and 75% of total revenue requirement. What happens if the operating segments do not meet the 10% of threshold test? Therefore, the segments are not classified as reportable segment. It needs to be combined and disclosed under other segments category. We have three quantitative threshold categories. The first one is revenue basis. We need more or same of 10% of combined revenue of all operating segments. Second, asset basis. We need more or equal to 10% of the combined assets of all operating segments. And the third and last one, profit or loss basis. We need more or equal the profit or loss of profit making, loss making segments, whichever is greater in absolute amount. The next process, we need to satisfy the 75% total revenue requirement. To identify it, combination of external revenue of identified segment must be more or equal to 75% of the total external revenue of entity. What happens if the 75% test did not meet? We must identify more reportable operating segments, even though the segment failed 10% threshold test until at least the 75% meet. Let's make the 10% threshold test using revenue basis. The first one for business segment. From the table, we can conclude there are two reportable segments, which are upstream in plantation and downstream in plantation. Next, for geographical segment, here we can conclude there are only one reportable operating segment, which is Malaysia. The next process, we need to run the 75% threshold test, as we can see for business segment. Since FGV's business segment meet the 75% threshold test, the reportable segment will remain the same and no need to identify additional reportable segment. As for geographical segment, the combination of the reportable segment resulted to only 67.8% of total external sales. Therefore, the additional segment must be identified more reportable operating segments, even though the segment failed the 10% threshold test until at least the 75% meet. The additional segment, which is India and Asia segment, shall be included and identified as a reportable segment since it resulted the combination of external revenue exceeds 75%, which is 79.67%. The other four geographical segments that are not reportable and are combined and reported as other segments. After we run the 75% threshold test, here are the results. The new segmental report for FGV can be shown in the table. There are still two reportable operating segments for business segment. And here the result for geographical segment. As we can see, there are three reportable operating segments now, which are in Malaysia, India, and Asia.
So now we have come to the end of the segmental reporting. Like other things in this world, segmental reporting also has its pros and cons. So the last discussion would be the advantages and disadvantages of segmental reporting. We will go through the advantages first. Firstly, the key advantages of segmental reporting is transparency. For business that operate in different categories or segments like FGV Holdings Berhad, segmental reporting reveal which areas are profitable and which are drains on the bottom line. Therefore, the management of the company can take the initiative to maintain its profitability of the segment and increase the profit of the other segments. Next, segmental reporting also helps the investors to get a clearer understanding of the fluctuations that could impact overall figures. For example, if a company report much higher than expected earnings, segmental reporting shows where those earnings come from. The shareholder may look at the same report to decide if the numbers are sustainable. It is designed to provide accurate information to the investors, which leads to a better understanding. As for disadvantages, manipulation of data may occur. Segmental reporting is used for data manipulation if the information is published in the true management's eye style. This offers companies management more discretion in deciding how segments are constructed and what components are to be provided. For example, the managers will manipulate and change the data of the companies in order to attract the shareholders and investors to invest in their companies. Other than that, managers might misuse the authority given by the company and neglect their responsibilities to make true and fair view report. The false report will affect the company's reputation in the public's eye. As the result, investors, customers, even suppliers might lose their trust towards the company. This will affect the company's reputation and profitability, or worse, it also may affect the company's sustainability. Therefore, management, employees, as well as the top managers have to be transparent and honest about the company to gain the trust and for the reputation of the company.
Thank you, Ms. Nuris, for the good explanation just now. Moving on to the next slide, I would like to discuss about Part B, Interim Report MFRS 134. Now, let's begin. Let's take a look of basis of preparation. The financial statement of the group and the company have been prepared in accordance with the Malaysia Financial Reporting Standard MFRS, International Financial Reporting Standard IFRS, and the requirement of the Companies Act 2019 in Malaysia. The group and the company have taken into consideration COVID-19 pandemic impact at the current economic environment on the basis of preparation of the financial statement. The director of the company continues to consider that it is appropriate to prepare financial statement on the concert basis. Interim report will be presented together with the group's audited annual financial statement for the financial year ended 31st December 2021. MFRS 134 interim financial reporting adopt the district method basis for the preparation of the interim report. The interim period is the separate period and is prepared periodically. As we move ahead to the next slide, type of interim report. For your information, the company prepare an interim report quarterly that is issued 4 times a year. There are 4 types of interim report made by FGV company, which are: the first one is unaudited then consolidated statement of comprehensive income. Secondly, unaudited then consolidated statement of financial position. The third one is unaudited then consolidated statement of changes in equity, and the lastly is unaudited then consolidated statement of cash flow. Next, the accounting policies. Inventory, which consists of commodities-based product and their related derivatives, are stated at the lower of cost and the net realizable value in the accordance with MRSS 102 inventory. Cost is determined using the weighted average and the first in and first out basis. Property, plants and equipment. All property, plants and equipment are stated at the cost less accumulated depreciation and impairment losses in accordance with MFRS 116 property, plants and equipment. All property, plants, and equipment are depreciated on the straight line basis to write off the cost of each asset to their residual value over their estimated useful life as follows. So here, we can see estimated useful life of PPE, building, structure and renovation 3 to 16 years, plants and machinery 3 to 30 years, motor vehicle 3 to 30 years, office equipment, tools and other equipment 2 to 33 years, barrel plant and livestock, oil palm 22 or lessee term if shorter, rubber tree 20 or the lessee term is shorter, others 25 or lessee term if shorter, and livestock 5 to 8 years.
Now, I am going to explain on the period for current and comparative of each statement prepared by FGV. FGV accounting period is ended on 31st December for each year. The current and comparative period for each statement is prepared according to MFRS 134 interim financial reporting. It is measured from 1st October 2021 until 31st December 2021, which is the fourth quarter of the year. In Statement of Financial Position, the reporting period for current interim is 3 months, which is 1st October 2021 until 31st December 2021. For the comparative end of the year, the reporting period is 12 months, starting from 1st January 2020 until 31st December 2020. For the Statement of Comprehensive Income, the reporting period for current interim is 3 months, which is 1st October 2021 until 31st December 2021. And the reporting period for the cumulative year to date is 12 months from 1st January 2021 until 31st December 2021. For the comparative current interim, the reporting period is the same, which is 3 months, but it started from 1st October 2020 until 31st December 2020. While for comparative year-to-date, the reporting period is 12 months, starting from 1st January 2020 until 31st December 2020. The reporting period for cumulative year-to-date in Statement of Cash Flow is 12 months, which is from 1st January 2021 until 31st December 2021. Same as cumulative year-to-date, the reporting period for comparative year-to-date also 12 months, but it's starting from 1st January 2020 until 31st December 2020. In Statement of Changes in Equity, the reporting period for cumulative year-to-date is 12 months, which is from 1st January 2021 until 31st December 2021. In comparative year-to-date, the reporting period is also 12 months, starting from 1st January 2020 until 31st December 2020. Next, we will continue with the adjustment made by the company. On 30th November 2021, FGV vacated a building that it owns and had occupied for many years. On the date, the building had a carrying amount of 1 million ringgit Malaysia and a fair value of 1,600,000 ringgit Malaysia. Upon vacating the building, that entity entered as lessor into a 5-year operating lease agreement over the building with an independent third party. The entity measures property, plant and equipment using cost model and investment property using fair value model. Hence, the journal entry are debit investment property 1 million ringgit Malaysia, accumulated depreciation 200,000, and credit property, plant and equipment 1,200,000. And next, debit investment property 600,000 and credit asset revaluation reserve 600,000. So for the second adjustment, on 1st January 2021, FGV had ending inventories of 30,045,600 ringgit Malaysia. On 31st December 2021, the company had inventories of 25 million units at a cost per unit of 1 ringgit and 50 cents. The price of inventories changes every year. At 31st December 2021, the net realizable value of the inventories is 1 ringgit 20 per unit. The value of the inventories shall be recognized at its net realizable value amounting to 30 million ringgit Malaysia, where 1 ringgit and 20 cents times with 25 million units. The loss of inventories of 7,500,000 should be recognized in the statement of profit or loss.